Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by the CCIM C5 Global Summit. It's an incredible summit. It happens every year. This year, it's going to be in Hollywood, Florida at the Hard Rock Hotel, September 17th to September 19th. And I'll give you the website so you can check it out, get more information. It's c5summit.realestate. And I will be there. So say hello. I'm going to be speaking on one stage. I'll be doing some interviews on the big stage. So say hello if you can make it. All right. Well, let's talk about a topic that is very interesting, I think, to everyone in commercial real estate today, and that is the mortgage business, the lender, the banks. What is going on there? It seems like we've all been waiting for the shoe to drop, if you will, on lenders kind of working through some of these loans. Been a lot of kind of forbearance agreements, kicking the can down the road. We've also have, folks trying to get loans, and what's happening there. Some banks are busy, and some are not. Well, let's get the true story. Please welcome my guest. It's Jamie Woodwell. He's head of commercial real estate research, the Mortgage Bankers Association. Jamie, good to see you again.
Good to see you as well. Thanks for having me back.
Yeah, thank you. So first, let's talk about origination. So, activity. We need more money. We need more money, more money. Our listeners are trying to get loans. What do you see out there?
Yeah, it's a bit of a logjam still, and you see this across both the sales transaction market and the mortgage originations market, where if you look at 2023, originations and sales activity were both down about 50% in 2023 versus 2022. You look at the Q1 numbers, and Q1 was down for sales transaction activity and flat for mortgage origination. So really no more taking place than what was already a pretty slow start to 2023. You do see differences within capital sources there. So a bit of a pullback from the banks, but some pickups from the CMBS market, from investor-driven lenders, from life companies. So there's definitely capital out there. There are lenders who are ready, willing, able, and anxious to make loans, but they're looking to do it at sort of today's terms, right? Where rates are today, where values may be today, those types of things. So that sometimes works for a property, and sometimes it may not.
Yeah. What do your folks tell you at the association there, all your members, about their feeling on interest rates and moving forward?
Yeah, I mean, interest rates have gotten so much attention, right? And partly because of the big changes that we've seen, partly because there's uncertainty about where we go from here. Some of that uncertainty comes from the Fed. So when you look at the Fed and what they're signaling for rates on the short end of the curve, lots of conjecture about what might happen. We have our own forecast. But it's interesting, if you look at the Fed's own forecast themselves of what the members of the Federal Open Market Committee expect to happen with the Fed funds rate that they determine, there's lots of different opinions within the Fed on where they're going to be. If you look at where they think they'll just end this year, you've got a little bit less than a third of those FOMC members saying that they're going to sort of sit pat where they are. You've got about a third, a little over a third, saying they're going to drop rates once, and roughly a third saying they're going to drop rates twice. And so, if that's from the folks who are actually going to be making that decision, I think it reinforces the point that they've made that they're data dependent. They're still looking at the data that's coming in. They're still sort of reading the tea leaves and going to be making the decisions at each meeting. That's different than the longer term rates, right? That the longer term rates are affected not only by that, but by a host of other things. And when you look at, I think, expectations 6-9 months ago, it was sort of universally held that rates were going to be coming down pretty significantly. I think now lots of folks have gotten past that and are sort of saying, there's uncertainty. If you look at the way the forwards market has predicted rates, if you look at the way economists have predicted rates, not a great track record there. And so rather than trying to to predict where rates are going to go and build a business plan off of that, I think we're hearing a lot more folks saying the rates are going to do what they're going to do, and folks need to sort of be in the here and now and work with what you've got.
Yeah, I agree with that. And we're seeing some of that as well where, folks, well, I'm going to wait. Interest rates drop. Well, your buildings are getting older. You're getting older. Leases are getting shorter. Yeah, there's not a lot, on the market in some cases. So it could be a good time to sell, and also maybe a good time to buy if some of the buyers have slowed down, especially dependent on leveraged buys, right?
Mm-hmm. Yeah,
Right.
I mean, there's always the opportunity, right, to out there, and I think we are seeing that people are looking at those fundamentals. The other piece that we've discussed before is every property is so different, and every loan is so different, and so now in particular, the particulars of one deal or one loan or one property are going to put it in a very different place than what might seem like a similar property, next door, across town, something else. That whether it be the property type or the market or submarket, the borrower type, the lender type, the vintage of the deal, all of those things come into play in making each commercial real estate transaction and loan really unique at this point, and needing to be dealt with as sort of that individual thing that it is.
Yeah, I'm glad you brought that up, Jamie. It was such a good point, and I can give listeners a prime example of that. I sell office buildings mainly in the Southeast U.S., but right here in Atlanta, where we're headquartered, I just closed an office deal at $360 a square foot, and I'm about to close one in Atlanta as well. It's office, $57 a square foot. To your point, every building can be very different. And speaking of office, let's talk about delinquency, the stress market. What are you seeing out there in the mortgage world?
Yeah, so it's interesting. We do a survey that we started right at the beginning of the pandemic that tracks delinquency rates on commercial mortgages across different property types, different capital sources. Uh, and we started at the beginning of the pandemic, and you saw immediately retail and lodging loans delinquency rates spike. That's where the pandemic really hit home the hardest. And slowly over time, those delinquency rates have been coming down, but have remained elevated. Just over the last few quarters, we've seen the office delinquency rate really start to tick up. So hitting 6.5% at the end of the first quarter. We're going to be doing the second quarter update to that survey in the coming weeks. We'll have newer numbers, but overall, there has been that trend up in delinquencies. Definitely, office in a very different place than other property types. But overall, the sort of questions about some properties, space markets, the rise in interest rates, some of the uncertainty around property values, all of those playing a part in pushing some of the stress up from really what had been remarkably low levels, certainly before the pandemic, and even through the pandemic as well.
Yeah, and one thing that's feeding that delinquency is the amount of maturities coming up, right?
That's right. So we've got about $930 billion of loans set to mature this year, 2024. It's interesting. If you go back to what was set to mature in 2024 as of the end of 2022, so a year previously, you saw a fraction of that number. So a real rise in what was set to mature this year, as a lot of loans that had matured in 2023 were pushed out a year. Saw some extensions, some built into the loan or initially, and then some worked out between the borrower and the lender. So an awful lot maturing this year. It's really interesting, though, that you've got a lot of variety in what's maturing. So you've got a lower share of multifamily loans, of the multifamily loans outstanding maturing this year, and a higher share of office loans. You have a lower share of GSE and life company loans maturing this year, and a higher share of bank loans, CMBS, SASB deals, and investor-driven lender loans. So that gets into sort of those different loans have different types of characteristics, and so there are swaths of the market that aren't seeing a lot of maturities and have had 10 years to see incomes increase, values increase, et cetera. And then you've got some loans that were done more recently that haven't had all that time to sort of see those improvements. Might have been made off of an adjustable rate on a mortgage, which would have had a very low base rate. So that gets back to that really unique nature of each property, and sort of how some loans that are be maturing really sort of a no sweat situation, while others are going to face some challenges and or need to have new capital brought in, be worked through in one way or another.
Yeah. Well, that's a lot of money. I mean, you think a billion here and a billion there, pretty soon you have real money, right? That's
That's
the
right.
old saying. What about the regulators, Jamie? It seemed like early on in this cycle, I'll call it, they were saying, "Hey, beef up your REO department, but don't be quick to foreclose. Hang in there a little bit." Do you know what's being said now to lenders from the regulators?
Yeah, I mean, I think it's really interesting. If you look at regulators sort of over time, there's always been a keen appreciation for commercial real estate lending. There's incredible guidance out from all the regulators that's focused on just commercial real estate, whether it be guidance around prudent workouts, guidance around sort of special approaches that the regulators expect if a bank has sort of higher levels of commercial real estate or has grown those levels. So there's always been a really sharp focus on commercial real estate. Back at the during the GFC and then the early days of the pandemic, they re-upped some of that guidance, just sort of going back through, making sure that it really applied. They've been very focused on that. And so what I think you're seeing now is them putting some of that to work in going in as the headlines and other focus has come on commercial real estate. So without a doubt, the regulators are out there looking at banks and other institutions and their commercial real estate books, making sure they're following the rules, doing what they can be, should be doing. You then see that in comments, from Chair Powell from the Federal Reserve when he's asked about the risks of commercial real estate on banks' books. So there's definitely a focus from regulators. They're on the case, as they really have been for decades at this point.
Jamie, from your desk, what do you sense for lenders and banks kind of working through these loans and maybe stop kicking the can down the road?
Yeah, I mean, I think it's interesting that expression, the kicking the can down the road. I think lenders, servicers are always trying to figure out what's the best course of action for a particular property or loan at a particular point in time. And when there's uncertainty, uh, or there's certainty that things will sort of progress, that sort of wait and see or the extension of the loan often makes the best sense in the world. And so you've seen that as a tool, certainly at the onset of the pandemic with forbearance. You also saw that back at the GFC. And as I mentioned last year, we saw a fair amount of that. They're also then working through, well, when isn't that the best course of action? And sort of what are the steps to take at that point? And so I think that's what you're seeing folks work through is, given the information we've got right now, what is the best course of action for a particular loan, for a particular property, and how do I get that from here to there? If you look at the Q1 data from the FDIC on banks and what's going on there, you saw a real uptick in the last few quarters, particularly from the larger banks, in what they're setting aside, the dollar volume of loans they're charging off. So the loans where they're saying, we're just going to put this in the rearview mirror. We don't think we're going to be fully repaid for this, and rather than sort of hold out hope, we're going to take the charge now, put it in the rearview mirror, and move on. You see that also in the dollar volume of loans that they've been putting in non-accrual status. You haven't seen that quite as much from the smaller and mid-sized banks. And, I think a really interesting question is the degree to which that is because the larger banks have the largest regulatory or investor scrutiny. You certainly have seen that investor scrutiny in their earnings reports and the number of questions that they've they needed to respond to, particularly last year around commercial real estate. But I think you also have a situation where those smaller and mid-sized banks have very different assets than the larger banks. They're much less likely to hold a large downtown CBD office property loan than would a larger bank. And those larger banks then have gone through their portfolios, looked at those, taken those charge-offs that I've mentioned, et cetera. So really interesting situation there. But I think you do have, again, the investor scrutiny, the regulatory scrutiny, and then the institutions themselves working through their books, looking at what they've got.
Yeah. On our end, I sell foreclosed properties, work with a lot of banks, especially in the last recession. And now we're starting to see business pick up again. And I was talking to special assets at a large bank last week. And he said, yeah, there used to be this saying, your first loss is your best loss. And I'm like, well, I don't know. Sometimes I think, selling notes at a really big discount might not be your best loss. It could be the worst loss or the biggest loss. So I think, doing short sales with borrowers who are cooperative, or sometimes just going the foreclosure route. So that's kind of interesting to see moving forward. Well, before we go, Jamie, could you give us a tip that you could leave us with for lenders, and maybe a tip for borrowers, and maybe start on the lender side? It seems like, to me, this is a great time for lenders to build relationships. They have less competition. They're probably going to get better debt coverage ratio, maybe better down payments, and better borrowers and properties. What tip do you have for lenders out there today?
Yeah, I mean, I think what we're seeing with lenders is there is this sort of two worlds, right? There's the existing book, and one looking at one's existing book and finding where there are challenges, aren't challenges, how to work through those, and then also not to be hamstrung where there aren't challenges. But I think then, to your point, there's also the opportunity, and that these tend to be the times when folks look back and say, wow, those were some great loans we made. That once you reset to today's interest rates, to today's property values, to sort of today's understanding of where the space markets are, all of those things, there's lots of great properties to be lending on. And I think you hear that from the lenders. There's a lot of interest, and in some ways, they sort of wish that there was more coming in the door from the borrowers than there currently is.
How about a tip for borrowers in the current market?
Yeah, I think on the borrower front, there was a book years ago I read that sort of had as its main theme sort of be here now. That wherever you thought the markets were going to go, or whatever you thought was going to happen, sort of don't be stuck in that mindset. Sort of take a look around you at where things sit now. Again, with regard to space markets, to the debt markets, to the equity markets. And sort of make the best decisions and take advantage of the opportunities that are here, given the reset that we've been going through in commercial real estate the last year or so.
Yeah, that's a good point. I think there's going to be a lot of money made from investors and users who buy properties today, especially office properties. It should be incredible. Sometimes I use a saying with some of our clients: says, "Look, you want to make your decisions looking through the windshield, not through the rearview mirror, because you might get in a wreck."
I like that.
Well, Jamie, thanks for joining us. Good information. Thank you, sir.
Total pleasure. Thanks for having me.
All right. And thank you for listening or watching around the country. Please let us know what you think. Hey, if you will, please share the show with others. Pay it forward. We do the show for free for you. Maybe you can pass it along to someone else. And if you have any ideas, thoughts, questions for me, my email is an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by CCIM C5 Summit. We'll be at the Hard Rock Hotel in Hollywood, Florida, September 17th to 19th. Visit c5summit.realestate. By CREI Summit. This will be in Atlanta, Georgia, September 11th to the 13th, right here in Atlanta, Georgia, where we're headquartered. Visit cresummit.com. by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Show.